And it's about conditioning. I mentioned earlier that we're all conditioned a certain way. Even when it comes to investing. I mean, I provide examples of what our parents tell us. You're watching TV. If you watch CNN, you're conditioned to think what they think. If you're watching Fox, you're conditioned to think what they think. It's just the way you are. I mean, honestly, for me, I watch both. For me, I watch CNBC all the time. I try to watch Fox Business because it lets me see what the investors are thinking of. It lets me, it's mainstream. And if you could prove mainstream wrong, you're going to make a ton of money in stocks. But it's important to think like this as an investor. And people say stock splits provide no value. I'm a fundamental analyst. I understand that. I understand that $10 is the same as 10 singles. I get it. But you cannot tell me it doesn't provide value after you saw what happened to Apple and what you saw what happened to Tesla and will happen to Google, Berkshire, any of those huge price stocks if they announce stock split. That thing is going to surge. So you could be a value investor and say, this is ridiculous. I don't understand. Or maybe buy a small portion of some of these stocks. Jump into Google's. Get in Berkshire. Buy a few shares because you know you're probably going to get a good 15% plus pop if they announce a stock split. And why wouldn't you do that if that's providing value? But I get it. Is it meaningless from a fundamental point of view? Fine. But for some reason, it's being viewed as a technical indicator right now, not as a fundamental indicator. And just to see people, oh, this is a joke. And watch Tesla, where, what is it, up like 35, 40% since the split? Since they announced the split? Is pretty incredible. While everybody's bitching. Obviously, the people are bitching are the people that don't own them. People tell you, Zoom, Tesla can't go higher. Zoom, expectations are sky high. They blew them out of the water. Those numbers were incredible. Yes, it's trading at a crazy valuation. Yes, people are going to say it has a bigger market cap than Boeing and compare it to everything to try to justify it. Who cares? Follow the trend. The trend is, if Zoom is going to continue to put up these crazy numbers, that stock is going to go a lot higher even from this price. That's it. That's what the stock is based on. That's what it does. Forget about fundamentals, just like Disney. I was wrong on Disney. Forget about the fundamentals on Disney. I was looking at it from a fundamental point of view, and I still don't understand it from a fundamental point of view. But I can tell you something. I'm bullish on Disney now because I think Mulan is going to change the landscape of how we view streaming. I think they're going to sell the crap out of it because there's no movies out there. And everyone's going to die. And hopefully they sign partnerships. They should sign partnerships with everyone. Netflix, and do affiliate deals and collect 30%. Again, it's free money to them. But if Disney's not down based on those fundamentals now, everything's going to get better and better. So for me, my emotions, and I lose money on that stock, yes. But I'm not like just pounding to Disney every day. Just like when you look at Tesla, the Bears, I mean, man, they crushed that stock. I'll talk about that in a minute. But you know, another thing, the U.S. is filled with debt, which will eventually crush our economy. Guys, debt doesn't matter. I know, I said it. You're going to send me an email, frankcurzioresearch.com. What are you talking about debt, man? The only thing that matters is if you're paying your debt. And we're paying our debt. Maybe the states aren't. That's fine. But if you look in corporate, they're paying the debt. The ones that aren't, going bankrupt. But most of these companies are. Interest rates are super low. It's going to be very easy to pay this debt. It's not a problem until it is a problem. Believe me, there's millions of warning signs. If debt becomes a problem, you'll know it. You'll see it in the bond market. You see it in swaps, credit default swaps. You'll see it in just so many different areas. And it'll be highlighted on CBC every single day. You'll see it, but it's not a problem. Stop worrying about it. You've been worrying about it for 20 years and nothing. You watch the market go higher and higher and higher of something that you worried about that you didn't need to worry about. Imagine what you could have done if you cleared your head and the stocks you would have invested in. Train yourself to think differently, to ask yourself, what if my thesis is wrong? What if everything I believe about a story is not right? Because getting back to Tesla here, I've seen tons of really, really, really smart investors telling me Tesla was going to go bankrupt. And that's okay, because we all get things wrong from time to time. That's fine. They could have run out of money. They're done. They're accounting. Everyone, the executives leaving. The cars are terrible. All this shit that you've been reading. They've been saying since stock was at 300 and it went to 22, 2,300. Now trading at what, 450 after its 5-1 split. But they're still saying the same thing today. Tesla's terrible. Elon Musk is a crook. Not realizing that the average investor following you on Twitter has been short the whole entire time because he's following you. Now he no longer follows you because they had to sell their mobile phone because they're completely broke, and you're still pounding the table on something that didn't work. Imagine all that time. All that time could be spent on finding new ideas. Just move on. You were wrong. But if I can give you any advice, the most important advice, don't be one of these people shouting from the top of the roofs that no matter what the data is, the dollar is going to lose its reserve currency status. Man, how many books have been written about? How many books have been written about crashes and revised about crashes and more crashes and more crashes? We're at all-time highs. Look at the S&P 500 since the 50s. It's the biggest secular chart you'll ever see. Higher and higher and higher. But don't get to the point where you're conditioned that you won't even listen to the bearish side, especially of your favorite idea. Because it's a terrible way to invest. I see this so many times at perma-bears just continue to short the markets, and they're not looking at the data. I mean, one good example of this is COVID. I mean, for me, I was incredibly bearish. I think I could say that I called that the market was going to crash. It crashed. I was still bearish at the bottom because I said, wow, even if the government comes in and they spend as much as they did in TARP, or even up to even double TARP, which is about $480 billion to save the whole entire market, I was like, the whole economy is closed. They need to shut the stock market. And how are they closing every single business for months, and they're going to keep the stock market open? Notice by May, I changed my thesis because I had no idea the Fed would spend over $7 trillion, 35% of GDP, to support everything. That's a pretty big data point. And since May, we've been long. We've been doing great in our portfolios. We've been bullish. I don't like the fact that they're doing this. I don't like the fact that they're spending a ton of money. But it doesn't matter what you like. It matters what's happening. That's the most important part. And remember, stocks don't have feelings. They don't love or hate you. So when the facts and data change, be willing to change on a dime. That's what the greatest investors do. Not only helped me generate huge returns over my career, which I'm sure a lot of you have been part of, followed me for over the past 25 years, but more important, it saved me a ton from having monster losses by being able to change my thesis once the data changes. Okay, guys, I want to thank you. We're still seeing huge demand for our Curzio Venture Opportunities newsletter. You know how I feel about small caps. I love the fact that so many people out there are saying that small caps are going to underperform. They're starting to perform. And a lot of these small caps are in the sectors that I mentioned that are most depressed, that are down a ton. And as COVID, we're seeing the data get better and better and better to the point where a year from now, I easily see 75, 80% capacity open across the board, across every state. Hopefully we don't have any setbacks, but we should have a vaccine, which will be taken by the people who are in a danger zone. And it's going to change the entire landscape where people are going to feel more comfortable and travel. But I've never seen a great opportunity in small caps, maybe once or twice during the past few crashes. But right now, they significantly underperform the large cap index, which is rare when you see a bull market. Usually small caps outperform on the way up and they underperform on the way down. And there's a lot of opportunities out there. You're looking at the Zooms, you're looking at all these stocks that are up hundreds and hundreds of percent. These stocks are still down 25, 30% from their highs. And if you look at their quarters, no one's paying attention, guys. No one's paying attention to their quarters. And I highlighted this because I just recommended 3 stocks in Curzio Venture Opportunities. Their numbers are much better than expected. They're seeing huge demand in 2021. Bookings are starting to go through the roof. And these guys have done a great job when it comes to leverage. We're providing themselves the opportunity where, hey, if this continues for another year, we're going to be okay. So we recommended several stocks within these sectors, have high hopes for them. I think they're going to go up tremendously. But it's rare that you're finding stocks that are down so much. I'm not talking about buying these cyclical names and buying oil companies right now. I think that's late to the party. Chris McIntosh was on. He really likes oil right now, but it's more of a long-term thesis. For me, when you're looking at the ones that have been impacted the hardest by COVID, and you could throw oil in there, I just don't think you're going to see that much demand for oil. It's going to take a little bit longer. You're seeing prices go up a little bit because there's a lot of supply that's coming off the market. They just can't make money at current prices. But when it comes to these cruise ships, when it comes to, again, you don't just want to buy any cruise ship. You don't just want to buy any casino. You want to make sure those fundamentals are good. Liquidity is the name of the game, guys. You got to look at liquidity. How much money do they have if they could only stay open at 25% capacity? You want to make sure that's longer than a year, because that capacity is going to grow and grow and grow. And when this economy and when COVID, that risk is totally gone, with the amount of money flooded into this market that the Fed's throwing recklessly, and how these companies significantly cut their costs, you're going to see earnings, profits, sales explode. And the stock price is going to follow. So I want to thank all of you who have subscribed to Curzio Venture Opportunities. We're still offering that 60% discount. That's on our website if you're interested. If not, no problem. Maybe small caps are not your thing. But very excited about this product, and thank you, because there are a lot of people subscribing to it. Again, that 60% discount is only available to listeners, people on a file. We're not sending that offer out to anybody else. So if you want to take advantage, it's probably in an email you can take advantage, or you could do it on our site at curzioresearch.com.